Hi, I'm Graham from Inca Chartered Accountants. One of the questions we get asked most frequently from our clients is, how much tax will I pay? Well, as soon as your accounts are done, we'll know to the penny. But of course, that may happen several months after your financial year end, and it's great to have an idea of how much tax you're likely to pay well in advance of that. So what I'm going to show you is a way to estimate your tax liability. It is only an estimate. We won't know for sure until your accounts are done, but it'll give you something to guide as you look ahead through the course of the business year. The amount of tax you pay is dependent upon the type of business that you operate. So in this video, I'm going to look at the two main types, the sole trader and the limited company. If you're a sole trader, you can earn around about £7,500 a year in profit, so that's not sales, that's your sales and then take off your costs, and you're not going to pay any tax on that money. But as soon as you go above that level, you're going to start paying tax at a rate of 20%. That's the same as somebody who's in employment. But you're also going to pay Class 4 national insurance. Now that kicks in at a rate of 9%, making your total tax hit 29%. Now the Class 4 national insurance is interesting because people think, oh well, my national insurance, I get a pension, I get hospital cover. Yeah, you've already paid for that in a direct debit that goes out of your account every month. This is just tax. You don't get any extra benefit from having paid it. So in order to work out how much tax you're going to have to pay, we need to look at your profit month on month. You take your sales, you subtract your costs. Not your drawings. That's money that you take out. Leave that to one side for the moment. Once you've got that profit situation in place, £600 every month, that's yours, free, nothing to worry about. But after that £600, you need to be putting nearly a third away. So that's 1/3 for the government, 2/3 for you. Stick it in a cash ISA. It gets paid in January of each year. But be careful, because you may also have what's known as a payment on account if your tax bill is high, and that's going to kick in January and July. Now the limited company is completely different, because you're not taxed. It's the company that's getting taxed. And a company doesn't have any tax-free amount that it can earn year after year. A company pays tax as soon as it makes £1 of profit, and it pays tax at a rate of 20%. That's 20% on all its profits, all the way up to £250,000 approximately. Now that's a 9% saving for most average earners. That's quite significant. A company has to pay its tax 9 months after its financial year. So calculating it, what we say is, you take your sales, you subtract the expenses that the business incurs, that's your costs, salary perhaps, supplier invoices, and that gives you your profit before tax comes off. Then put 25% away to be on the safe side. So it's 1/4 for the government, 3/4 for you. That's what you can have as your dividend income. One of the pitfalls that a lot of businesses get into is they think, there's my profit, I'm going to take a dividend and I'm paying tax on the dividend. No, that's wrong. The tax gets paid on the profit, and then it's your bit, the dividend that comes afterwards. Remember, what I've just told you, it's about estimating your tax bill. If you want to know exactly how much tax you're going to pay, send us your accounts. In the next video, I'm going to talk about how to get a dividend out of your company.